Guys, Carl Allen back with you for video number 2, just moving my very handsome British face out of the way here, just teasing. Still got the Invisalign in, so apologies for the lisping. But in the first video, we walked through the forecast model just for one standalone deal, and we forecasted almost 14x cash-on-cash returns for the investor in this deal, and almost a 69% compounded annual growth rate in that investment. So absolutely killer returns for an investor. But you can make those returns actually higher if you want by doing bolt-on acquisitions, right? So if you're a real deal maker, you're not going to stop at just the first deal. You're going to do deal origination, on market, off market. You're going to get tons of deal flow. You're going to buy the best business first, and then you can always bolt other companies onto it, and you can use the cash flow that the business one generates to kind of fund that acquisition. So let's assume that so this is like a big beef farm store. There's a lot of beef processing, sells a lot of beef, great business, doing nearly $4 million right now. We put a model in to scale that up to about $10 million in revenues within 5 years. Very easy to do that if you're from that space. Again, always stay in your lane, guys. Buy businesses in areas that you know, or partner with people. Otherwise, you're not going to be able to prove how you can generate that explosive growth. So let's say we do the deal, and in 2024, we execute on the original growth. So 20% growth, some margin improvements. So we have a business doing nearly 4.8 million in revenue and about $1.7 million, in EBITDA. So great business. But then you might want to bolt something on as well that's complementary. So when you're doing a bolt-on acquisition, you've always got to look for two things. Number one, does it have a product or a service that I can sell to my current customers, and vice versa? Does it have a customer that I can sell my current product or service from business one into that? That's called cross-selling. I have a video on that on YouTube that you can watch in a bit more detail. And then number two, we're looking for financial synergies, right? So we're looking for bringing the two businesses together, and they've been able to take out a lot of kind of duplicate costs. Both of those two things, the cross-selling and the extracting the cost synergies, that means more money drops down into the profitability, more profit, bigger multiple, bigger valuation, bigger exit, bigger returns for investors on this deal. So this is really, really powerful. But let me walk you through how it works. So let's say we went and found a bottle shop, right, that's close by, and we can take that bottle shop and we can plug it in the existing facility, right? So we're going to save on rent and utilities and property tax and maintenance and like all that crazy stuff. And there's going to be a lot of cross-selling opportunities because people are going to come in, they're going to spend $500 on meat to smoke, and they're going to say, well, wow, let's buy $100 of wine or cheese or nuts or whatever we want to kind of enjoy with our meal. So this is a great kind of bolt-on acquisition. So what we can then do is we can forecast, again, everything in the blue cell, you got to populate. That's the variable. Everything else calculates for you. Don't touch a cell. If it's not blue, please, you will break the model. So let's say with the meat shop and the bottle shop, we can cross-sell 20%. So over the course of a year, 20% of our meat customers will buy alcohol and stuff, and 20% of the alcohol people will come to buy their wine or whatever, and they're going to buy meat whilst they're in the facility. So that's cross-selling. So the cross-selling at 20% gives us about a $1.4 million of additional revenues. Let's keep the cost of sales and the margins the same for now. But then we're also going to have 20% at least in cost synergies, probably more like 40%, but let's keep it at 20% just to be conservative. So as we bring the bottle shop into the meat shop, we're going to save on all these things. Let's say we save 20% of our total costs, right? So we're going to save 20% on our cost of sales. So that'll generate an extra $617,000 in cash flow. And then we're going to save 20% of our SG&A. So 20% of the existing business that we own, the new business that we've bought, plus the cross-selling, 20% of all that saving is going to be $494,000. So that's going to make an extra $1.1 million of cash flow of profit just by combining these two businesses together and doing that integration. So then at the end of 2024, we're going to have about 8.1 million of revenue. We're going to have the 4.78 from our first business, 2 million from the bottle shop, plus the 1.35 from the cross-selling. And then we're going to have about $3.7 million of EBITDA because we're going to have our existing EBITDA plus the EBITDA from the bottle shop that we've bought, plus the cross-selling EBITDA, plus the EBITDA from the cost savings of bringing the two businesses together. So the model adds all those up. So we've now got a business doing 8.1 million and making 3.7 almost of EBITDA. So what's great about cross-selling and what's great about doing bolt-ons and taking all the duplicate costs out is your profit margins go a lot higher. So we have a business already doing 35% margin. That was from the original forecast. We've bought a business doing 25% margins. By combining everything together and doing what I've just explained, we're now cranking best-in-class margins for this type of business, over 45% profit margin. So that's going to make it very, very attractive for an investor to get involved in your deal. And then all we do, exactly the same as in the first video, is we just continue to grow at 20%, right? So we're growing at 20% every year with all of our marketing and all of our new things that we're going to be doing. Again, you've got to justify what they are. You'll know what they are based on your deal and based on your skill set and your experiences in that industry. But if we take the 8.1 and we compound that growth 20% per year, by 2028, we're not at 9.9 million anymore. We're at 16.9 million because that bolt-on acquisition has given us a big boost. It's allowed us to put the afterburners on. And let's keep the gross margin at the same. So we're at about 70%. Let's just flow that through. You might get an extra point a year if you want by further economies of scale. But then the adjusted EBITDA calculates everything itself, and then we get those we get those stronger margins because again our SG&A, our overhead is going to come down overall as a cost of fulfillment. So then what we're doing is valuating the second company. That deal is going to cost us. I won't go through what I did on the last video. Go watch it if you didn't see it. So the video calculates this business to be worth about 1.275. The model factors this in to the entire roll-up. And then it calculates then the returns. So again, if I'm coming as your investor, I'm buying 15% of this deal, I'm getting $6.8 million of EBITDA at the end of the term. That's going to be worth at least a 10x multiple. Again, bigger profit, bigger multiple. We were at 8 times 3.4 for the first example. We're at 10 times 6.8 in the second example. So this business is worth 68 mil. Add the real estate again, take off all the debt that we're going to be taking on as part of this acquisition. So we've now got a business, the equity's debt-free, cash-free, worth about 61 million. I own 50% of that, so I'm going to get 9.2 million and change back. So I'm putting $242,000 in to partner with you on this deal, and then I'm getting $9.2 million back. Thank you very much. Like, why on earth would I not do this deal? I'm making 30.2 times my money, cash on cash. And I'm doubling my money every year. I'm making a 97% internal rate of return, compounded annual growth rate over 5 years. I leave my money in my private bank. I'm getting 1%. I invest it in your deal. You do a roll up. I'm doubling my money every year. I'm getting 30.2 times my money over a 5-year period. An absolutely amazing deal. And again, this is a real deal. This is an exact deal. We haven't found the bottle shop yet to plug in, but the meat shop, it's under LOI. We've got all the financing kind of laid out for this. This is an absolutely phenomenal deal. So I hope you've enjoyed that, guys. Don't forget to do 3 things for me. Number 1, hit like. Number 2, hit subscribe so that you can get all my videos sent to you in real time as I upload them. I'm going to be going crazy with content over the next few months. I want to make sure that you see it all. And then don't forget as well to click the link underneath this video so that you can download this model, and then you can plug your own numbers in it, playing with the blue cells, and effectively get the returns to your investors so that they'll fund you deals. Again, hope you enjoyed this. See you on the next video. Until then, bye for now.